Hi, I'm Jennifer Dixon. I'm from Moores, and today I'm talking with Rowdy, one of the senior lawyers here at Moores, about the take we've got on the proposed changes to superannuation, particularly for those people with balances over $3 million. So Rowdy, this new tax that's been all over the press, how's it going to work?
So broadly speaking, the government is looking to impose a tax for members of superannuation funds that have more than $3 million in their balance or in their accounts. So that excess over the $3 million will attract another 15% tax. It's a notional calculation, so it's not like it's just on earnings or it's just on at the sale of an asset or something like that.
And is the $3 million indexed?
No, it won't be. So they're not looking at indexation like they have with transfer balance caps or total super balance in some cases. They are looking at keeping that at $3 million.
So that would say to me that even if I'm not at $3 million now, I should be thinking about this.
Absolutely. So clients or members of superannuation funds who do have over $3 million in their account, absolutely this is something that's going to affect them. Whereas it's also possible for people who are close to that or have invested in something that's going to grow in its value, or also clients where for example, if they're going to inherit a pension, for example, from their spouse, and that is going to tip them over the $3 million. So if we've got two clients with $1.5 million each, obviously we're going to be approaching that $3 million kind of limit at that point.
Right. And so when's all this supposed to start?
So the law is due to take effect from the 1st of July 2025. Although we have already been looking at this for a number of clients who know for sure that they are over that $3 million cap. And that's because decisions about whether or not assets remain or wealth remains in the superannuation fund need to be made now.
Yeah.
And they need to be made now because of timing of capital gains tax events, but also considering different implications like differing asset protection that might be afforded by the wealth staying in the superannuation fund versus coming out, estate planning intentions that they may have as well, and then other tax implications as well. We're looking at assets or wealth coming out of a superannuation environment where it's concessionally taxed into a personal or into an individual's name where all of a sudden we're attracting marginal tax rates.
So the panic response of pull everything out of super?
There's merit in thinking about it. It's not necessarily pull the trigger and do it now, but there's merit in thinking about what the options are and pull it out of super, keep it in your own name, put it into a different type of entity, a trust or a company, or keep it in the super. There's definitely a number crunching exercise that involves usually the accountants, not the lawyers, but then obviously having the lawyers involved to talk about what the different implications are going to be.
So where does someone start when they're thinking about this?
I think the starting point will need to be, seeking the advice. So seeking the advice, whether that's from a financial planning perspective, an accounting perspective, or a legal perspective.
And probably all three.
And in due course, it will involve all three.
Yep.
Yep.
Thanks so much for that, Rowdy. That's been really helpful. That's only really been a very general overview, so please feel free to contact the team at Moores as a starting point, and we can hopefully point you in the right direction.